American government, fiscal and monetary policy. The last time I was personally in Washington, D.C., I visited a building that is not generally on the tourist list of must-see locations. Yet it housed one of the most important institutions of American power. It wasn't one of the buildings housing the CIA in Langley, or the J. Edgar Hoover building, home to the FBI, or even the U.S. Pentagon. It's the building that housed the first bank of the United States. Today, the central bank is called the Federal Reserve Bank, or as it's very commonly called, the Fed, Federal Reserve or Fed. So the Fed is not technically a part of the United States government as it operates. It's a bank. The Federal Reserve Chairman is, in some circles, thought of as the second most powerful figure in Washington, D.C., more powerful than the Speaker of the House, the Senate Majority Leader, or even the Chief Justice of the United States Supreme Court. Ever since the Great Depression of the 1930s, the United States federal government has assumed responsibility for managing the nation's economy, with the specific charge of keeping unemployment and inflation both low. The Fed, created by Congress, is a major part of that congressional effort. In fact, maintaining high employment rates and low inflation rates is known as the Fed's dual mandate. It is why the Fed exists. It is commonly believed that the Federal Reserve's economic tools can be more effectively targeted and more quickly applied than the economic tools available to members of Congress. And yet, it is important that we remember that the Fed is staffed by academics and bankers who have no direct responsibility to the average American voter, and it is far from insulated against the shifting winds of American politics. Few events have had a bigger impact on U.S. policy than the Great Depression. In response to the economic crisis, the federal government, through federal legislation crafted by a Democratic Congress and President, tried to institute a makeshift federal social safety net for the economically vulnerable among the population. They crafted seemingly limitless bills aimed at implementing new federal regulation of American businesses during much of the decade-long Depressionary episode. Among the federal agencies created during the Depression were the SEC, the Securities and Exchange Commission, which is tasked with policing the stock and bond markets. Remember, a big stock market crash sort of touched off the recession. And the Social Security Administration, which administers the Social Security program of old age and increasingly disability benefits, Social Security Administration. The Great Depression also channeled lawmakers thinking about the government's role in the economy at the national scale. Even the expression, the economy, came into use only during the Depression. Before then, the government had more or less kept its hands off of economic affairs, letting the various local and state economies of the U.S. move through a natural cycle of boom and bust. Economies would grow and expand with investment, and about once a decade, economies would inevitably suffer when malinvestments or bad investments had accumulated in any one sector. As a result, unproductive businesses would fail, and their capital would be reallocated to stronger businesses, and the cycle would start anew. Prevailing theory through much of modern history is held that recessions would inevitably self-correct, kicking off another period of prosperity and productivity gains. But starting with the Great Depression, and specifically with the election of Franklin Delano Roosevelt in 1932, 2 years into the recession, the federal government has actively sought to manage the U.S. economy, seeking to shield the voting public from the less than desirable consequences of recessionary economic episodes, always with an eye on the next election. At the time of the Depression, FDR had at his disposal a number of new and powerful tools. In the lead up to World War I, Congress had passed the Federal Reserve Act, legislation that created our current Federal Reserve banking system. The Federal Reserve Act empowered America's central bankers with that dual mandate to maximize employment and keep the money inflation low. The Federal Reserve was thus given power over the money supply in the United States and, by extension, the national economy. That same year, the 16th Amendment to the United States Constitution was ratified, which authorized the direct tax on every individual earner's income. These two tools have been wielded with a heavy hand now for over a century, and quite controversially. I'll explore two major policy approaches made by government in this talk. First, fiscal policy, fiscal, which refers to the government's taxing and spending decisions, and is carried out by Congress and the President. In that discussion, we'll look at different approaches to fiscal policy, demand-side policy, which is based largely on government spending levels and consumer activity, demand side, and supply-side policy, which is based on tax rates and other costs to producers. We'll also discuss monetary policy, which involves adjustments made to the money supply, driven mostly by the Federal Reserve. Capitalism, in which goods are traded freely between individuals, is inherently cyclical. Picture the ocean tide slowly coming in, cresting on the beach, and then slowly moving out to sea once more. When business is picking up, new employees are hired, individual spending and investment increases, often leading to further economic growth, still lower unemployment, more confident consumer spending, meaningful long-term capital investments, and accelerating technological innovation, etc. It is through this pattern that Americans have steadily raised their standard of living over the past 3 centuries. The opposite is also inherently true. When a capitalist economy weakens, when the tide starts to go out in this example, businesses and consumers often start to make decisions that can accelerate a broader economic downturn. Faced with declining demand for their goods, firms cut back on production, which often means letting go some of their workforce. Meanwhile, consumers begin to save personal income instead of spend it, resulting in further job losses, declining innovation and capital investments, etc. In short, every economic wave has both a crest and a trough. Before the Great Depression, government policy indirectly participated in this cycle. Faced with declining tax revenues as a result of declining incomes and profits during recessionary episodes, governments were forced to cut their own spending, contributing to ongoing job losses and reflecting the pattern of slowing business activity both at the state and federal level. Then in 1930, hot on the heels of a notable shift from a manic euphoria to despair on Wall Street, British economist John Maynard Keynes argued that government was doing exactly the opposite of what it should be doing. Instead of cutting back on spending into the obvious recession, he argued, governments should try to fight the tide. They should increase their spending during recessionary episodes. By doing so, he argued, government would be putting money into consumers' hands, which, if spent, could theoretically stimulate job growth and production. Stimulus. Keynes argued that global governments should try to short-circuit their capitalist recessions, essentially by running up federal deficits during economic downturns. He also advocated for removing such supports, paying off those deficits when the economic growth cycle returned, which is a detail that seems to have been lost on modern economists, policymakers, and the current membership of the United States Federal Reserve Board, but I digress. So-called Keynesian fiscal policy, centered on the demand side of the supply-demand equation, demand side. Increase the level of aggregate demand, the amount of money consumers are spending by stimulating the economy, and the effect will be an increase in aggregate supply, the amount of product producers are bringing to the market. Increased demand, and inevitably people will go back to work and build things. This new notion undoubtedly drove some of President Franklin Delano Roosevelt's 1930s New Deal programs. That's what Franklin D. Roosevelt called his broad swath of programs he brought to office. He promised a new deal with the American people. For example, his Works Progress Administration, that's an example of a New Deal program, or WPA, hired millions of jobless Americans during the depths of the Depression and assigned them to various public works projects. New parks, bridges, roads, and schools were built in hundreds of America's cities and towns. These so-called make-work programs fed federal dollars into local economies, temporarily boosting productivity at taxpayer expense in the hopes of kickstarting a larger economic recovery. Not everyone backed or even backed such economic notions. Proponents of, for classical laissez-faire free markets, it's French for leave alone, free markets, argued that federal government attempts to influence U.S. markets risked untold consequences by upsetting the natural relationship between natural buyers and sellers required for free markets and trade. The waves, buy and sell, moral hazard is the concern here. Still, American workers desperate for relief from the Depression were willing to trust Roosevelt, electing him literally 4 times to the presidency. Truly, FDR threw everything but the kitchen sink at the nation's economy. I know of no American president who has had as many components of his legislative agenda struck down as unconstitutional by the Supreme Court than did Roosevelt. Still, a rapid expansion of federal powers took shape both through legislation and executive order under Roosevelt and remained a Central American issue. Keynes' new demand-side fiscal policy had proven popular, if not particularly successful, during the global depression. The Depression lasted more than a decade, as the majority of Americans continued to delay major purchases and investments, believing costs would continue to fall in the future. That is what a depression is. Like rampant inflation, pervasive deflation can become a self-fulfilling economic phenomenon. In an inflationary episode, people try to bring future purchases forward because they fear prices going up. In a depression, people hold on to what they have and don't spend any money if they can avoid it because they believe prices will fall when the time comes to purchase that thing. Fast forward 4 decades. President Ronald Reagan assumed the presidency in 1981 in the midst of an economic recession, where the jobless rate had reached a post-war high of 11% nationally. He chose a very different approach from Roosevelt. Reagan targeted the supply side, convincing Congress to give a large tax break to businesses and taxpayers in order to stimulate production instead of demand. Reagan was a supply sider, FDR was a demand sider. Reagan's logic was that if businesses and the wealthy had more money, they would invest it in production in order to make more money, the supply side of the economic equation. To increase production, businesses would have to hire more workers. Their pay would then feed into the economy, stimulating further production and hiring. Reagan's supply-side approach came to be called pejoratively trickle-down economics, trickle-down, or voodoo economics. The idea that greater wealth at the top of society generates economic activity that trickles down to help those at the bottom. Reagan was, in essence, the anti-Roosevelt. Instead of promising that government policy would solve the people's problems, Reagan famously argued the opposite. During his first inaugural address, he stated plainly, "Government is not the solution to our problem, government is the problem." Demand-side policy emphasizes government spending as a means of putting money directly into consumers' hands, whereas supply-side policy emphasizes tax cuts for businesses and individuals who will invest their own money more productively than the government could. Indeed, the government is not a natural free market participant. Both of these approaches aim to reduce the jobless rate by influencing the business cycle. An alternative approach to improving the economy is called monetary policy or monetarism. Monetary policy. The leading theorist of monetary policy was and remains Milton Friedman, who formulated it at the University of Chicago in the 1950s. Friedman believed fiscal policy was largely ineffective, demand and supply, whether it came from Roosevelt, Reagan, or any other president. Friedman argued instead that the money supply, the amount of money in circulation, both in terms of cash, debts, mortgages, loans, etc., and digital bank balances, was the key to maintaining a stable economy, to leveling out the curves. When the economy is weak, he said the money supply should be increased. With more money in circulation by the Federal Reserve, firms and consumers would have more money to invest and spend, stimulating both production and spending. Friedman preferred private control over the money supply. He did not like the Federal Reserve, but recognized the Federal Reserve had the congressionally backed tools to do the job. Indeed, the Fed has since taken on the job of monetary policy, but it strayed quite far from what Friedman was thinking. To understand the Fed, you need to recognize that it's not an ordinary bank. It's a national one. It doesn't have customers like your bank does. It's a banker's bank. It's members of the national banks and those state banks that qualify and choose to join the Federal Reserve System. And it creates the things that you and I call dollars, which are actually, look at the top line, Federal Reserve notes. Since the United States completely abandoned the dollar's gold backing in 1971 by Nixon, these notes have existed simply as paper, or more like it's actually cotton, fiat currency, backed by the full faith and credit of the United States government, and credit alone. Fiat means by decree. Dollar is now operated as fiat for more than 50 years. The only other times in our history when the central bank maintained an unbacked dollar were during the American Revolution and the U.S. Civil War, both experiments that ended in terrible inflationary panics. But I digress. To deal with an economic downturn, the Fed today can employ a combination of 3 tools to directly affect the U.S. fiat supply of money. Number 1, it can lower its overnight lending rate. The rate of interest it charges its member banks when they borrow from it. The Federal Reserve is, after all, the nation's central bank. It's where money comes from. The lower the rate of interest the Fed asks for on the loans it makes to member banks, the lower the interest rate those banks can offer to their customers, ultimately the American people. Cheaper rates inevitably stimulate more borrowing, which in our fractional reserve system pumps even more money in the form of debt into the national economy. In a nutshell, lower that Fed funds rate, and they can just decide to do this, and you will eventually expand the U.S. money supply. The Federal Reserve can also affect monetary policy by lowering what's called the reserve rate. its reserve rate. Member banks of the Fed are required to keep on deposit a certain percentage of their assets. When the Fed lowers the reserve rate it requires banks to hold on to, member banks can make loans against more of their assets to customers, thereby putting more money into the economy once again. Finally, the Fed can, within strict limits, buy and sell securities, which is a catch-all term for many different kinds of investments, corporate and government bonds, U.S. Treasury bills, and so on. It has its own balance sheet. During an economic downturn, it can choose to increase its buying. When it buys a security like a U.S. Treasury note issued by the U.S. Treasury to pay for what Congress wants to spend money on, it gives the money to the seller. The seller, in turn, can spend or invest that money, in theory, stimulating the economy. The reserve balance, or debt, can sit on the central bank's balance sheet for as long as the Fed wants. Since the Great Recession of 2008-2009, the Fed has purchased billions of dollars in mortgage-backed securities from government enterprises Fannie Mae and Freddie Mac. You may not have heard those terms before, Fannie Mae and Freddie Mac, and many trillions of dollars in Treasury notes from the Department of the Treasury. These purchases of this debt, these debt instruments, have helped the government recover from two recent economic crises, the housing crisis of 2008 and then the COVID-19 pandemic of 2020. These purchases also quite directly have allowed Congress to run massive deficits year after year, while at least temporarily shielding taxpayers from the corresponding tax burden. Indeed, the Federal Reserve spends trillions of dollars to buy up debt instruments that otherwise people might not want to buy, which has held interest rates low, which continues to stimulate the economy. Each of these approaches, demand-side policy, supply-side policy, and monetary policy, has pros and cons for the American public, and each one also has a political dimension. To help you understand these dimensions, let's look at each policy approach, beginning with supply-side fiscal policy. When George W. Bush took office in 2001, the economy was in recession, with the stock market falling in response to the popping of the dot-com internet stock bubble of the late 1990s and accelerating after the terror attacks of 9/11-2001. That year, and in add-on legislation 2 years later, Bush persuaded Congress to enact tax cuts that included a decrease in the highest marginal tax rate on personal income from 39.6% to 35%, and a decrease in the capital gains tax, which is the tax on investments and other individual sales profits. I bought something for a certain price, I sold it to someone for higher. What's the difference? Capital gains. That figure was changed from 20% tax to 15% tax. These tax cuts benefited mostly higher income taxpayers, precisely the ones targeted by supply-side policymakers. The assumption was that these taxpayers would invest much of the money they saved, giving the economy a boost. Other taxpayers also got a tax cut, but in dollar terms it was smaller and less impactful. In Congress, the vote on the Bush tax cuts divided along party lines, particularly in the 2003 bill. In the House and Senate, over 90% of Republicans supported it and over 90% of Democrats opposed it. Why do Republicans tend to prefer supply-side fiscal policy? True supply-side policy fits their small government philosophy because tax cuts don't require a new federal program. Tax cuts are implemented through the existing tax code. For Republicans with a legitimate libertarian streak, tax cuts in theory represent a kind of starve the beast approach to fiscal governance. Starve the beast. It may be impossible to cut popular and expensive social programs in Congress, but as long as you can reduce the amount of cash flowing to DC via lower tax rates, there's hope that equally expensive programs will eventually prove untenable. In essence, cutting taxes is considered one way to stop the government from spending even more and further beyond its means. Bush optimistically argued that the tax cuts would eventually pay for themselves. I've heard that a million times. As the economy strengthened, incomes and profits would hopefully rise, and so would the government's tax revenues as a result. However, America was at war in the Middle East, gas prices were rising significantly, and the tax cuts did not have the dramatic effect Bush had promised. America lurched into the Great Recession just a few years later. In the end, according to a study of the National Bureau of Economic Research, the Bush tax cuts added hundreds of billions of dollars to the national debt, setting the stage for future presidents to run even bigger deficits. Now let's take a look at recent demand-side and monetary policy action, which came into play a few years later. In 2008, the economy took its sharpest downturn since the Great Depression. Bush was still in the presidency when the Great Recession began. And he persuaded Congress in early 2008 to enact a tax rebate. This was the first so-called government stimulus bill, which has come into vogue in the last few years. It gave $300 to each adult and dependent child to individual taxpayers making less than $75,000 per year. This was an unadulterated demand-side bill because its goal was to put money directly into consumers' hands in the hopes that their spending would spur production and job growth. Even though Bush, who had argued for supply-side economics earlier, backed the bill as a Republican, it was congressional Democrats who backed the bill more strongly, particularly in the Senate, where every Democrat supported it, while a third of Republicans were opposed. The Democratic Party coalition firmly tilts toward those in the extremes of the income range. People don't understand this. The extremely wealthy and those earning relatively low levels of income, that is the bread and butter of the Democratic Party. And people at the lower income range were beneficiaries of this major tax rebate bill. The money proved a welcome windfall to taxpayers, many of whom infamously spent the money on just-released high-definition televisions manufactured overseas. But I digress. Democratic President Barack Obama took office in early 2009 after Bush. An even larger demand-side stimulus bill was passed by his Democratic Congress. It totaled $787 billion and included, for example, more than $100 billion in infrastructure spending, such as grants for road construction and money for electric grid projects, nearly $100 billion in additional unemployment assistance, and more than $100 billion to keep state and local governments funded through the recession. These measures are consistent with demand-side theory, and they aim to put taxpayers' money into selected people's pockets. The legislation, as you'd expect, had the overwhelming support of Democratic lawmakers. 100% of Senate Democrats and over 95% of House Democrats backed the bill, while no House Republican and only 3 Senate Republicans supported the stimulus bill. The legislation fit the Democratic Party's philosophy of using government revenue and new debt issuance to protect the economic status quo and shield voters from the sting of economic recession. And it very clearly aided those who were part of the party's political coalition: union workers with government contracts, government employees, the marginally employed, and some of America's biggest corporations. It's unclear if the legislation worked as Congress's demand-side theory had predicted. What I do know is that the country moved towards sure economic footing thanks to a booming oil fracking industry in Texas and the declining domestic oil price consumers enjoyed as a result. The legislation certainly added significantly to the federal debt. The $780 billion tab was paid exclusively with newly borrowed money that would have to be paid back by taxpayers in the future. Generally, people who personally would never see any benefits from the $787 billion themselves. The sheer scope of the bill weakened its public support, which proved important when Obama came back to Congress to ask for a second stimulus bill. Republican opposition blocked it, setting the stage for 6 years of bickering between Congress and President Obama. Now let's pivot towards how the Federal Reserve responded to the economic downturn of 2008. The Fed concluded that one of its tools, the reserve rate, the amount that banks have to hold on to, wasn't going to be much help. Demand for bank loans was weak, and banks had a lot of cash on hand. So lowering the reserve rate and allowing banks to loan out more money wasn't going to help anything. So despite the loss of risk appetite among the public in order to stimulate demand for new loans, the Fed rapidly dropped the interest rate it charged member banks for their loans. The rate had been about 5% when signs of trouble in the housing market had first appeared. By 2009, the rate had dropped to 1%. It would soon go to 0.25%, 0.25%, almost free. Basically, free loans to member banks and incredibly low-cost loans to the American people as a result. The Fed was also buying securities at an incredible clip. The effect was to put money in the hands of securities sellers with the hope that they would use it in ways that would stimulate economic growth. By 2009, however, the Fed was running out of options. It had dropped interest rates to near zero. Nothing more could be done on that front. So the Fed resorted to what's called quantitative easing, QE. It began to purchase the assets of its many member banks, such as those mortgage-backed securities I mentioned earlier. The goal was to take these risky securities off their hands in return for newly issued money that they could loan to firms and consumers at these historically low rates. Where did the Fed come up with the money to purchase those trillions of dollars in bank assets? For all practical purposes, and the Federal Reserve says this themselves, the Fed created it out of thin air. The Fed is the nation's central bank and essentially has the power to print money and to keep printing it. And that's what it did from 2009 until about 2014. Never in the country's history had so much money been pumped into the economy. All told, the Fed spent more than $3 trillion on quantitative easing during this period of our history. Despite the gradual economic turnaround, the Federal Reserve struggled to sell its securities back into the market. So the Federal Reserve just sat on that debt and continued to hold lending rates low. And when market turbulence hit again, the Fed went back to its tool of last resort, renewing purchasing commitments in response to COVID-19. Today, the Federal Reserve Bank is sitting on 3 times as much debt, nearly $10 trillion, as it held when it first declared the experiment in quantitative easing finished nearly a decade ago. 10,000 million billion trillion. To give you a sense of how much money $10 trillion is, it is roughly the annual gross domestic product of the entire nation of China. Supporters of these actions by the Federal Reserve suggest we would have faced another Great Depression had the Fed not stepped in to buy up all these new debt instruments. But a hard truth remains. The Fed now sits on a pile of American debt that it will not easily retire into global markets. It has to sell this at some point. And global markets themselves have now come to believe that the Fed will step in and rescue the United States in an economic crisis, no matter the cost. The moral hazard here is obvious. 2 acrobats, one performing with a safety net and the other without a safety net, tend to make very different types of risk calculations. American and global investors have taken incredible investment risks in recent years, in part or maybe even in whole because they believe global markets are now backstopped by the Federal Reserve Bank of the United States. The final issue of the Fed relates to how it operates. On one side, admirers of the Fed point out that monetary policy is more flexible than fiscal policy. For instance, the Fed can drop its interest rate on a moment's notice, whereas fiscal policy first requires Congress to act and then it's slow in its implementation. Dollars for new construction projects, for example, take quite a bit of time to actually wind their way into the economy. The Fed's admirers also like the fact that it is less prone to acute type of partisan conflict that can hamstring Congress. Yet to some critics, that's a problem. It reveals that, even though the Federal Reserve Board of Governors serves set terms that require presidential nomination and congressional approval, the Fed is not fully accountable to the people's elected representatives. And critics also note that some of its actions are aimed mostly at protecting its member banks. An example would be the loans the Fed gave major banks, keeping them afloat after the market collapse of 2008. The Fed gave those institutions $7 trillion. That's 10 times the amount Congress gave those same banks through its controversial TARP legislation, the Troubled Asset Relief Program. The American public was highly critical of TARP. They disliked the fact that Congress was bailing out banks while leaving people who were losing their homes and jobs largely to fend for themselves. The public never had a chance to voice its opinion on the Fed's action because it was carried out in secrecy. When it came to light a few years later, the Fed claimed it had acted in secret so as not to cause a panic worldwide across markets about the scale of America's banking crisis. That's probably true, but the Fed clearly was protecting its member banks, using public resources to prop them up during a very difficult time for the country. In most other nations, the central bank is subject to greater transparency and political control than it is in the United States. In some ways, the Federal Reserve is not unlike the federal courts. It operates largely outside the reach of the Democratic majority. The justification for that in the case of the courts is pretty clear. They need to be independent of political influence in order to ensure justice is fairly served and blindly served. It's less clear why the Fed should have such wide latitude to act on its own. It is, after all, purely a creation of Congress and not a dedicated branch of government created by our founders. Let's look at a final example of the use of fiscal and monetary policy, the federal government's response to the steep economic downturn caused by the COVID-19 pandemic. When the viral illness of SARS-CoV-19 struck in early 2020, the economic fallout was rapid and severe. Hundreds of millions of Americans were asked to stay home and avoid travel and abstain from most of their regular economic activities. Hundreds of thousands of American businesses, large and small, were told by state and local governments to close their doors as a result, with many of them facing bankruptcy in only a matter of months. Congress responded with several $1 trillion in new stimulus spending, the $2.2 trillion Coronavirus Aid, Relief, and Economic Security Act, or CARES. They always come up with great acronyms for these. Some of that money took the form of forgivable government loans to enable firms to keep employees on the payroll, both those still on the job and those simply sitting at home. Some of it took the shape of grants to state and local governments to enable them to retain workers and maintain services like in 2008, but on a much wider scale. Federal unemployment benefits for the jobless were significantly increased, and the period of eligibility was extended by many, many months. In the hopes of further stimulating the economy, ironic because the country's economy was all but shut down, most Americans received many thousands of dollars in direct cash payment from the federal government. I remember when the CARES Act allocated over $1 million to our community college and stipulated that colleges receiving aid had to give away at least half of those dollars directly to students. Students could complete a simple request form and receive thousands of dollars in new federal aid just by merit of being enrolled in school. It was, in essence, an incredible experiment in demand-side fiscal policy. On the monetary side, the Fed cut interest rates to zero, allocated $700 billion for yet another round of quantitative easing, and provided emergency loans to banks and municipalities. Collectively, the actions of Congress and the Fed were the largest ever government response to any sort of crisis in world history. Congress and the Fed have once again proven that they will do whatever it takes to shield the American voter from as much pain from an economic downturn as possible, no matter the cost. At the time of this recording, the pandemic is finally relenting. With America out from under the cloud of the COVID-19 virus, one cannot help but wonder if the parabolic explosion of both public and private debt has left Americans more vulnerable than ever to unseen crises waiting just beyond the horizon. Military threats from the Far East, out-of-control price inflation as a result of all this money printing, or perhaps even a genuine crisis of confidence in the strength and integrity of the US dollar itself.